Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. For the first time in Trump's new term, inflation surged last month, hitting 5% annualized, up from just 1.9% over his first 6 months. Sadly for legacy media, it was not tariffs, it was federal spending, with the deficit up 20% over last year. Last week, the now infamous Bureau of Labor Statistics announced inflation. CPI surged 0.4% in August, which is annualized 5% and double the previous month. Now, just last week, I talked about the BLS revising away 1 million fake Biden jobs, as in they're not very good at math. And independent price aggregator Truflation says inflation in August was 2% on the button no clouds in sight. Still, the BLS remains the standard for everything from markets to policy, so let's break it down. Now, media was desperate to pin the CPI bump on tariffs, but in fact, just the previous day, wholesale PPI inflation came in at an actual decline, as in tariffs are not passing on. So what is driving CPI? The biggest were energy and food, which are both domestically produced, and above all, housing, which is not imported, but is measured on a goofy 9 to 12-month lag, meaning housing is still running on Joe Biden's fumes. And considering housing is 36% of CPI, that's a lot of fumes. In fact, since Trump took office, the BLS says housing inflation shelter is up 2%, when actual housing prices, according to the Fed itself, fell 3%. In fact, take out the BLS's goofy housing costs and the entire jump last month disappears. Meanwhile, CPI for tariff goods, so furniture, clothes, consumer electronics, were up less than overall inflation, as in the tariffs are not leading, they are following. So what are they following? The money, specifically the debt, including the mother of debts, the federal deficit. Starting with private debt, in July, revolving credit grew at an annual rate of 9.7%, while household debt is rising almost $200 billion per quarter, which is good for nearly 2% of extra inflation over a year. Bank loans, where commercial banks literally print up new dollars to lend to you, are up 6% annualized since Trump took office, and those are set to grow even faster if Trump's trillions in foreign investments start to flood in. Finally, the big kahuna, the federal deficit, rose 20% on the year, with spending up $400 billion despite DOGE. As was partly rising debt interest, which now costs more than the military, but mostly it was social programs that Congress puts on autopilot so they can pretend the budget is out of their control. Together, these are pumping fresh dollars into the economy, whether literally printed by banks or borrowed out of cold storage and put into circulation. That is driving prices. It's not Chinese socks. So according to the Cleveland Fed, inflation expectations are 2.6% for the next year and 2.4% for the next 5 years. Now, this does not hold a candle to Biden, but it is above the Fed's target, as in normally they would not cut rates. And it could get worse as the factory building boom Trump wants translates into even more inflationary loads. In short, federal deficits have become so big that even a healthy economy is inflationary. "43% of Americans expect to work until they die, double what it used to be. Meanwhile, half of Americans say it is, quote, not realistic to expect a comfortable retirement." This comes from a recent survey by consumer finance company Wallet Hub, with similar numbers from a May survey by State Street. What's driving it, of course, is stagnant wages, soaring prices, especially housing and medical bills, and above all, soaring debt that Americans are using to bridge the gap. Starting with wages, while deportations are finally growing blue-collar wages, real household income has been down since 2019, the first time that's happened since the 2008 crisis. In fact, it's never happened outside of recession, which we allegedly did not have under Joe Biden. Meanwhile, even though inflation has moderated under Trump, there's still a massive cliff from post-COVID inflation, when prices rose 25% by official numbers, maybe 40% unofficial. The problem with big inflation jumps is people initially respond by going deeper into debt to maintain their previous lifestyle. Now, 5 years later, that is catching up, with Americans taking on an additional $4 trillion in debt, hitting $20 trillion in household debt. That includes $1.2 trillion in credit card debt that carries 24% interest, slightly lower than the mafia. That's not even getting into housing, where the combination of a 40% jump in home prices, a doubling of mortgage rates, and soaring insurance and property tax means the median mortgage payment is now $2,300 a month. Before the pandemic, it was $1,200. Add the debt and the interest, and incomes don't buy close to what they did before COVID. For anybody below middle class, it is hand to mouth. A recent Fed survey found almost 40% of Americans cannot cover a $400 emergency. So how are Americans making ends meet? Easy, they are raiding retirement savings. According to the BEA, the national savings rate is now 4.4%. Before COVID, it was 7.5% to 8%. In the 1980s, it was 11%. Meanwhile, according to Vanguard, the average 401k balance is just $38,000, which will get you through about a year and a half of retirement. Then the last man standing, children. Children are the traditional retirement account. You have a bunch of kids, raise them right, they pitch in to take care of you. When you're old, of course, that no longer happens, with the fertility rate plunging post-COVID to just 1.59 children per woman. Given 30-somethings are still eating ramen with their roommates, that's not remotely enough to carry elderly parents. So what's next? For 200 years, every generation doubled incomes like clockwork. This broke in the 1970s when Nixon finished off gold and handed the economy to an inflationary Fed. We exported our jobs to China and Mexico and imported illegals to finish off blue collars, while Wall Street feasted on the real economy. Trump's doing what he can between deportations and manufacturing, but there is a lot of ground to make up, and the clock is ticking for millions of Americans. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold, paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to our show. Last week, Vladimir Putin advisor Anton Kobiakov accused the U.S. of using crypto to wipe out the national debt. Will the federal government rug pull the $37 trillion it has borrowed? More important, should it? So first, Anton's logic. While some hoped he meant a gold or Bitcoin takeover, his actual claim is the U.S. will issue stable coins, which are crypto tokens designed to be worth exactly $1. And we transfer the national debt onto those tokens, default on them either partially or with a haircut, and presto, burn the crypto bros, and we get a fresh slate. So this is goofy on a number of levels, starting with the fact stablecoins have to be backed by cash or treasuries, unlike the dollars banks print when they lend money. But most important, stablecoins are fungible. They spend just like the dollars in your bank account, meaning if you mint $37 trillion fungible tokens, you've effectively printed 37 trillion real dollars. This would make inflation go up something like 200%. Moreover, the exact tokenization that Anton's describing happened decades ago when FDR broke the link with gold and then Nixon finished it off. So outside the paper in your pocket, dollars today are nothing more than numbers on a spreadsheet at the Fed or a bank. Even the paper gets siphoned away, diluted by those numbers on a spreadsheet. So think of post-FDR dollars as the in-game token that, thanks to Lincoln's legal tender laws, you have to buy to play in the massive multiplayer game called the American economy. Basically Roblox bucks with pictures of presidents. So we've already been rug pulled, both the dollars and the debt, which is denominated in dollars. Indeed, that's why the Fed can print all the dollars it wants without having to buy gold. They are just tokens. The only thing keeping those tokens, or the debt, real is the fact the Fed would have to hyperinflate to get rid of them, which the Fed correctly predicts would have them decorating lampposts, metaphorically, of course. To illustrate, if the Fed wanted to get rid of the national debt, they could do it tomorrow by printing $37 trillion tokens, called quantitative easing, buying up the entire national debt and canceling it. You get 200% inflation, sure, but you would be debt-free. In fact, the Fed did just that in COVID, although it was only $6 trillion, and they didn't buy and cancel debt, they pumped it to Wall Street by buying everything in sight. So as next, Anton may have forgotten about hyperinflation as dollar rug pull, but he's correct that we can absolutely default on every penny the federal government owes, especially the part owned by foreigners. They don't vote, and given our massive military, there's not much they can do about it. In fact, we did just that in 2022, seizing $300 billion owned by the Russian central bank as punishment for Ukraine. We can absolutely cancel the other $9 trillion of national debt held by foreigners. Personally, I'd toss in the $2 trillion Wall Street banks own as payback for 2008. Of course, in theory, at that point, no foreigner or banker would ever lend to the U.S. government again, which maybe is not a bad thing. That's a very fast way to a balanced budget. For the first time ever, right populists are leading the polls in all three big European countries, Britain, Germany, and France. Give it a couple of years and Europe could out-Trump Trump. In Britain, Nigel Farage's Reform UK is currently ahead of both major parties. One poll projects if the election were held today, Reform would hold as many seats as both major parties combined. In Germany, a recent poll also put the populist AfD ahead of both major parties, which are currently running in a grand coalition, a suicide pact, specifically to shut out the AfD. In France, the supposed far-right National Rally has led polls all year, with their 2027 presidential candidate dominating with a 10-point lead, while the French government just collapsed as populists block Macron. The question for long-suffering Europeans is, when do votes translate into power? Now, none of these countries is required to hold an election until 2029, but about half of elections in Europe are so-called snap elections, held early when a ruling party loses majority support in parliament, like just happened in France. What's driving it all is two key issues that have European voters very angry: mass immigration and the cost of living. The past decade, Europe has taken in millions of third-world migrants, spawning no-go zones in major cities. Half of London and Paris and three-quarters of Brussels is now foreign-born. On inflation, during COVID, European central banks printed almost as much money as the Fed, and they got the inflation to go with it. Meanwhile, Europe's regulatory state is even more ridiculous than the U.S., by some counts 2 to 4 times more intrusive. This strangles the economy and it drives up prices, so stagflation. Of course, immigration and inflation are also key issues in America, but in Europe the anger is even more intense because they've had near-zero growth going on a decade. The pie is not growing, freeloading migrants and runaway inflation are going to leave a mark. So as next, Europe's globalist establishment will not go down without a fight. Major parties can shut them out with coalitions like Germany's doing, which buys time. Also ramped up censorship, especially in Germany and Britain, which has locked up thousands for offensive speech when migrants stab schoolchildren. Europe's corrupt state-owned media will, of course, smear populists. Then the nuclear option, which is already happening in Europe, lawfare. France recently banned prominent populist Marine Le Pen. Germany is mulling a complete ban on the AfD, which will backfire. And the EU recently canceled Romania's elections since the populists won, while freezing funds to populist governments in Poland and Hungary to scare their voters. Going by history, these will all backfire spectacularly. The Nepal riots just illustrate that bans increase voter anger, and when it boils over, it won't be pretty. This means when Europe's repression fails, when the smoke clears and populists are voted in, Europe could go much harder than the U.S. Mass deportations, slashed spending, decimated bureaucracies that could dwarf what's happening in the U.S. Give it another 5 to 10 years, and Europe could make Donald Trump look like a moderate. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. And one of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. What happens if the Fed stops manipulating the economy? Will we be eating the cat food? An upcoming Supreme Court case will decide whether the Fed is independent of voters, as in independent of Trump, or if the unconstitutional Federal Reserve can continue like an occupying army, manipulating our economy for their banking masters. The case in question involves Trump firing Fed member Lisa Cook for mortgage fraud. Mainstream Keynesians are in full panic at the prospect of voters controlling the Fed. But the deeper question is, should the Fed exist at all? After all, the Fed was sold as protecting the dollar and stabilizing the economy. The pitch was no more recessions, no more financial panics. Instead, we got at least 15 recessions, one every 7 years, at least 4 banking panics, 1929, the Fed's masterpiece, along with the S&L crisis in the 80s, 2008 financial crisis, a pre-bailout in 2023, and myriad mini crises also bailed out, all whilst the Fed gutted the dollar by 97%, the wolf guarding the henhouse. So getting rid of the Fed is surprisingly easy. You don't even need gold. Just announce the Fed will no longer target rates, so shut down the so-called open market committee, nor, this is key, will it provide bailouts. So the discount window and ad hoc bailouts like QE and BTFP back in 2023 allow existing Fed assets to mature and roll off, canceling the dollars printed to buy them and lowering inflation. Presto. So what happens then? For starters, Wall Street collapses because Wall Street is a pyramid scheme built on recycling, rehypothecating, assets with implicit Fed bailouts. This actually happened in 2008 when W said he would not bail out Lehman Brothers. So pretty much every bank and investment house goes bankrupt without the Fed's bailouts. They don't disappear. Shareholders get wiped out. They get bought for a song by people like Warren Buffett, who run them as sound banks. So Wall Street's smaller, hookers, and yachts hardest hit. But specifically what happens to interest rates, which drive both inflation and recession. Happily, we know because our fair republic did not have a Fed for its first 150 years, including a 30-year period, the so-called free banking era, when they didn't even have government bailouts, which they did by suspending gold redemption. As you'd expect, not only did we have no boom-bust cycles or financial panics, but interest rates were higher, about a point or two higher on government debt and closer to 3 to 4 points higher on corporate debt. This is because today, all these debts are cheap because they enjoy an implicit Fed bailout. You may remember Ford, GM, AIG, Fannie Mae in 2008. So if they're no longer getting bailed out, the rates go up. The higher rates would then hit all assets, including stocks and house prices, which might fall 20 to 30%. And the Wall Street casino would be over. Bankers would go from hookers and coke to the 1800s bespectacled elder in a conservative suit. So it's next. The Fed is not ending anytime soon. Historically, it takes a crisis. Prediction market Kalshi is currently running 10% odds of Trump, quote, ending the Federal Reserve. Still, it's useful to look past the Wizard of Oz. In short, no more boom busts, no more bailouts, at the cost of a one-time 20 to 30% haircut for boomers, cheaper houses, and mass extinction for Wall Street. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.